Welcome back to All Things Money. I'm David Blain, and during today's show, we talked a little bit in the first segment about long-term care insurance. If you missed it, just head on over to the World Wide Web at www.dlblain, that's DLBLAIN.com. And within a week or so, we'll have an archived copy of the show up there for you to download and listen to. Or feel free to give us a call at 633-0107. And of course, we're always accessible by email at allthingsmoney@dlblain.com. During the end of the last segment, we started talking about exchange-traded funds, or ETFs. They've been a lot in the news a lot lately. Some good press, some bad press. One thing's for sure, a lot of confusion out there. And the definition of an ETF is a security that trades on an exchange like the New York Stock Exchange or the NASDAQ. It trades like a stock, and it typically was set up to track some sort of index, an equity index, a bond index, a commodity index. But it's essentially a basket of assets. And unlike a mutual fund, an ETF is continuously priced throughout the day. There is no manager that is making buy and sell decisions on the individual securities. And unlike a mutual fund, which is only priced once a day, an ETF can be bought and sold throughout the day, as well as you can get an actual price for it throughout the day. They're extremely liquid vehicles for the most part, and that's where a lot of the confusion stems from. The original ETFs, the SPDR, ticker SPY, was set up to track the S&P 500. And then they started providers such as iShares, which is owned by Barclays, Vanguard, SSGA, which owns the SPDR family of ETFs. You have a sponsor that puts these ETFs together. And I thought a good way to explain it is an example. Let's say you think the energy sector, oil, is a good place to invest. That you think the worldwide demand for oil is not going to go away anytime soon, even with all these plug-in cars, that the demand for oil is going to stick around for a while. And so you want to have exposure to the energy sector. What are your options? Essentially, there are a couple options. Number one is to find a mutual fund or a manager that you think knows what they're doing, that will invest in energy companies through a mutual fund. And so you give your money to the mutual fund company, and there's a manager there that goes through, and on a daily basis he decides to own Exxon or Chevron or whatever in the portfolio. And once a quarter he has to publish his holdings. So you don't necessarily know exactly what you could own. The second way to do it is you could go out and you could analyze Exxon and Chevron and pore over their balance sheets and income statements and try to figure out which one of these companies is going to perform better than the others. The other alternative is you could just buy all the companies in the energy sector one by one, and you could purchase 30 or 40 different companies yourself in your account. And here's where the exchange-traded funds come in. Is they are perfectly suited for this. For example, this morning I ran a report on the Energy Select SPDR, ticker symbol XLE, and it's designed to give the investor exposure to the energy sector. So instead of buying an energy mutual fund where you don't necessarily know what is held in the fund on any given day, or going out and buying 25 or 30 different stocks yourself, or taking the risk that you know more than everybody else and picking Exxon over Chevron or Shell over Exxon or whatever, picking the one individual stock, you could buy the XLE ETF. And for example, as of today, it contains 19% ExxonMobil, 13% Chevron, 5% ConocoPhillips, 6% Schlumberger, 5% Occidental. You get the point. The top 10 companies in it are 64% percent of the total ETF. So it owns about 25 companies that have exposure to the energy sector. And so in one trade, you buy this ETF. In one trade, you now have instant exposure to the energy sector. You're well diversified across both large companies like Exxon, integrated companies, as well as Schlumberger, which is in the equipment and services sector. And so for one small fee, one trade, you can have instant exposure to that sector. So that's kind of how it works. It's like a basket of securities. And the securities that are in the basket are, one, known at all times, and number two, they don't change. So the percentages, of course, will change as the prices go up or down, but unless something is bought out or goes bankrupt or something like that, the securities in the ETFs are set. That what you're trying to get is exposure to that specific part of the market. You're not trying to say, one stock is better than the other. You just want exposure to the energy sector, and you want to know what you own. They're perfectly suited for that. As I mentioned, the SPDR, actually I have it here in my notes, it was first introduced on the Toronto Stock Exchange in 1990, and then they debuted in the U.S. in 1993, the SPDR. So over the years they've expanded. As I mentioned, they've gone from just a handful of ETFs to over 1,000 ETFs today. And when we come back in the next segment, we'll go over some of the relative advantages, disadvantages of ETFs, as well as how you can use them in your own portfolio. So for All Things Money, I'm David Blain, and we'll be right back.